Hi there. Let's start by learning a little bit about accounting and the basics of the accounting equation. So the first question is, why does everyone need to know accounting? And I'm sure you have to take this class as a business major and some other majors as well. So why do we make you do it? It's not just to be mean. If you think about tennis, when you hear them tell scores, they are talking about the score is 40 love or something is break point. And if you don't know what the words are that they use, you wonder what's going on. So the first part is just to learn the jargon. I'm not a soccer person, so when they kept saying the score was 3-0, it's like, well, why don't you say 3-0? It's because that's the way they do it. The other reason is if you think about basketball, I'm old enough to remember before they had the 3-point plays or they had the shot clock. And so when they put in those new rules, that really changed the strategy used by managers. You know, if you were down by 3 points at the last few seconds of the game, under the old rules, you had to make 2 plays, and now you can wait and decide if you want to do the shot clock or do the 3-point. You also have to get the ball up and back. Again, some of you might remember the old Tar Heels. They were notorious for just holding the ball for 10 minutes and taking the shot. And so that's one reason the shot clock was put in. So the strategy you used changes if you know the rules. And so that's why you really have to. And that all affects, if you're in management, often your bonuses are tied to accounting information. If your bonuses are, your promotions, if you're a store manager, the better your store does, the better. If you're an econ or finance major, then you're going to use these numbers to, again, make decisions, make those strategies. And the scary part is, or the sad part is, if you ask the accountant for a particular number, you might say, give me the division's profit. There's 5 or 6 different ways they can compute it. And you need to know which numbers you specifically want to include it and which ones you don't, because otherwise you'll make some really poor decisions for your company. If you're in marketing, then you really do need to know how much you make. And again, and therefore how much you can spend on advertising. And that relationship between how much you advertise and how much bang for your buck you'll get. And again, the accountants will give you some information. You got to make sure you're using the correct information, not just what they tell you the cost of the product is. And obviously for accounting, this is going to kind of be the basis for many of the other classes that you do. If you're in accounting, then it's all the classes. We'll start with this basics, but we can go from there. So regardless of your major, this really will come in handy. Might not be in the next couple of years. And a lot of times when you're a new hire, it doesn't come into play. But once you move up the ladder, you'll see where the numbers are used a lot. And you also, if you're in entrepreneurship, you need to know these things. Okay. So what is accounting? The accounting is, again, kind of a whole different language. It's a whole different way to think about transactions. And it's based on something called the accounting equation. And the accounting equation is assets equals liabilities plus stockholders' equity. And the key is, if I have 2 equations, those always have to be in balance. So some of you might have liked chemistry when you balance the equations there. It's the same thing here. You can't get that scale out of balance. So every transaction has two parts, and the way the two parts will counteract each other will make that scale stay balanced. So we need some definitions. So what's the definition of an asset? Well, the formal definition is it's something that has a probable future economic benefit. All right. It needs to be under the company's control. So if a friend of yours just borrows your car, it's still your asset. So it has to be under your control, even if somebody else maybe is using it for a little bit. Or same way, if you just borrow somebody else's car, it's not your car. And then it has to be the result of a past transaction. So if you're just planning to buy a house, again, that house isn't yours. You have to actually go and have the paperwork done so that it's put in your name. All right. In kind of a more kind of generic way to think about it, it's your stuff. Okay. So the stuff that you've got that has some probable future economic value, kind of that has value. That's the way you sort of look at it. And it gets more complicated, but for now, that's good. So the examples, the things you have, the easiest one you have is cash. And so if you have cash, that's yours. As we talked about, if you own an automobile or a car, that works. Buildings. If you're a company, and I'm just kind of spreading these around a little bit, if you have inventory, so you buy a whole bunch of, let's say we're selling computers, you buy a whole bunch of computers to resell, that would be inventory. If you buy a bunch of computers for your office, that's also an asset, but we have a different name for it. So these are things you plan, inventories, things you plan to sell. Other assets are things that you plan to keep, but they're still all assets. And another one is something called accounts receivable. I before E, except after C, receivables. Those are also assets, and those are IOUs from your customers. So if you sell that computer, but the person says they'll pay in 3 installments, then that promise to pay in 3 installments to you is an account receivable. It's an IOU from a customer saying that I'm going to do that. I'm going to pay you later. So I'm going to make this kind of a little bit easier. Let's say you have a pet grooming business, and so you buy a pet grooming table for $1,500 cash. Okay. When we say there's two things, I'm going to get this pet grooming table. So I'm going to increase the table, which again is an asset. It's something that I have, my pet grooming table. But I paid them cash, so I'm going to decrease my cash by the same amount, both for $1,500. So if you look back at my scale, it's still balanced. I just put something on this and took it off the asset side. So it's still, and that's what we mean by you always have two things. So again, assets, if assets are the things the company has of value, liabilities and equity basically tells you who kind of owns those assets. And the choices are you owe people, for them. So you bought that car and took out a loan, so you really owe the bank, while you have a car the bank kind of owns them, or your investors, which is kind of you, hopefully you're one of your investors, own the asset. Okay. So a liability is the first part of that. It's what the company owes to others. And again, be a little careful with owes versus owns. I try to say it distinctly, but it sometimes gets a little jumbled. So what the company, I got the word company out of here, what the company owes others. So those are things like bank loans. So if I would buy a car and get a loan on it, there's something called accounts payables. And those are normally things that, again, where you owe, often it's for inventory or normal business activity. Think about that pet grooming table. If instead I put it on a credit card, now I don't own it quite yet until I pay off my credit card. And so I'm still going to increase. I still get the table as my asset, but I'm going to increase an account payable instead of cash. So again, I've got two sides. And if I look back by scale on this one, I'm going to increase the asset, but I'm also going to increase the liability by the same amount. So my scale stays balanced, just in a little different way. So if you think about buying inventory, for example, on those computers, when I buy the inventory, I can either give them cash, or I can say, I'll pay you later. And that, in which case it goes to accounts payable. In all the situations, I still get the asset. I get to show the asset because I have control over it. But in one case, I still owe somebody for it. And for the other one, I've already got it paid off. Lots of liabilities. Liabilities have the word payable in the name. So really we'll have things like, if you think about it, you work and then you get paid. So you have wages payable. If you're a company, you might have utilities payable. Your utility bill comes after you use it. So lots and lots of the things, when all else fails, if you see the word payable, it's probably a liability. There's a couple exceptions, but it's probably a liability. So that takes us to that last little one, which is stockholders' equity. And that's just kind of what's left over. If you buy something, if you have an asset and the bank doesn't own it, I guess you do. And so and when I say you, I mean the company. So the company does it. The nice thing is we're going to do in a corporation accounting. So we're going to assume you're working for a corporation. If you're still a proprietor, you got the same thing, but you give them different names. There's only 3 accounts you're going to work with in this class, or 3 main ones. You have common stock, and that's when you start a company, you issue stock, and every stockholder owns a little piece of the corporation. Okay. You have dividends. That's what you pay out to your owners. Let me add some words up here. So this is your owner's kind of contribution to the company. So that's what they kicked in to start with. And this is what they take out. So this is, they kick in a little bit of money to get you started, and then you have to pay out. You don't have to, but a lot of companies will pay out a little bit to the owners just to keep them interested. And then retained earnings. As accountants, we are not creative when we name things. And so while that seems kind of complicated maybe, this is the earnings the company has made over the life of the company, and this is how much is retained. That means the only way I reduce this is by paying dividends, and I increase it by every time I earn profits. And so this is what I'm left over with, basically, to keep that scale in balance. So retained earnings is the total kind of earnings of the company minus dividends, kind of the total dividends over the life of the company. All right. So it's just what's left over. So let's go through a little example and see if we can kind of keep our equation balanced. We always have to stay on the company side of the transaction. So remember, we're the company. So a company sells common stock to 4 new owners, and the company receives $50,000 cash. So it's always easy to start with the cash. So we increase some cash for $50,000. And we're going to sell common stock, so that's going to increase the common stock by $50,000. I'll probably stop putting in the second thing. So again, going back to our little scale, I got some cash and asset. I got some stockholders' equity account, balance. Okay. So next, we got our $50,000 cash. Let's go buy a car. Going to pay cash again. I always start with the cash. So here I'm going to decrease my cash. I'm just going to put the amount in the middle because both sides will be the same. And then what am I getting? I'm getting a car, and I'm going to increase that. So asset, increase, decrease, balanced. I'm not supposed to flip around with my pen so much. Okay, now let's say instead I buy a car by getting a loan. Okay, you can get your car with just your signature. If you've been watching those ads, something tells me it takes a little more. But I'm going to buy the car. Okay, so here I don't have cash, so I'll start with the thing I do know. I'm still going to get that cash.
Hi, I'm Miss Pebbles, your TA for the day. And what did she just say? Yes, she said you got cash, and you did not. You got a car. She wrote it down right, said it wrong. I'll pop in anytime she needs to be corrected. Hopefully I won't see you anymore today, but something tells me I will.
But now I've got a payable. Okay. So I'm going to increase, instead of the cash, I'm going to increase. I'm going to call it notes payable. You can call it loan payable. I don't care. For the 25. Okay. So it's the same transaction here. I get a $25,000 car, but here I owe for it. So kind of the bank owns it for a while. Whereas the other one I own outright. With the second, no, on the first one, I increased this and decreased the assets. On the second one, I increased the assets and I increased the liability. So still balanced, just a different way to get my car. Okay. Now let's get a little fancier here. Now it's not for just your signature. They want a little cash up front. So now I'm going to buy the car by putting $25,000 down and getting a loan. Well, we can get a little bit more complicated and still leave our equation the same. I'm going to leave my car over here. So that goes up. But what I'm going to do is I'm going to decrease my cash here for $5,000. So kind of take the first part of that one. But I'm going to increase my notes payable for $20,000. My car is still $25,000. I just got there a little different way. Still have a car, and my equation's still balanced because I took a little bit out here, but then I increased my payable. So if you look at your asset side, your assets went up by 25, but then down by 5, so 20. Your liabilities went up by 20. Okay, call that a compound journal entry because it's more than two things going on. So let's go and start our pet grooming business again. And I start by putting $100,000 in the checking account, and I received 10 shares of stock. So even if you're a sole proprietorship, you can set yourself up as a company, and it gives you some legal benefits, as you learned earlier. So that's what I'm doing here. I'm going to set it up as a LLC to be fancy. So I get some cash for the business, goes up by 100,000, but the company is issuing some common stock, and the value of those 2 shares is also 100,000. So it must be 10,000 a share, and you can set those up any way you want. So again, cash is an asset. This is an stockholders equity account. And I'm going to abbreviate that SE because stockholders equity is long. Then I go out and I buy some dog shampoo for $60. And let's say that this is dog shampoo that I'm going to try to sell. Okay, so it's on my shelves. So I'm going to buy some inventory. Yeah, do it this way, which is cash. 60 times 20 is 100. Let's see, 6 times 2 is 12 and 2 zeros, so $1,200 we're going. All right, so I'm going to increase.
Okay, now, obviously cash is not inventory, and this is either really expensive shampoo or this was supposed to be $60 for all the bottles, but at least she could do a little bit of math in her head, so I guess I'll give her props for that.
My inventory, which is an asset, but I'm going to decrease my cash, which is also an asset. Okay, by the 1,200, I've got my inventory. Now somebody comes in and has their pet groomed for $100. What's different about this? It's not really an asset. It's not a liability. I don't owe anybody, and it's definitely not stockholders' equity. So what is it? Well, we need something else. We need a special place to kind of keep track of what we've made, what we've earned. And since it's earnings, think about it, it eventually will go to that retained earnings, but we don't want to muddy that up with 1,000 little entries. We want 1,000 little entries somewhere else, and we just want to pull that over to retained earnings in one step. We want to know how much we make every year, sometimes every quarter, sometimes every month if your bonus is made based on that. So we know that, again, the cash is going to go up for this $100. But the question is, what's the second half of the transaction?
Just a quick clarification, a sale like this will eventually end up increasing retained earnings, which is stockholders' equity, but we'll learn how that happens a little later.
And we have an answer, okay? And that's where that income or earnings or whatever you want to call it comes into play. So we have another little part of the accounting equation where it is revenues minus expenses equals net income. So the net income will increase if your expenses are kind of less than your revenues. And we have some synonyms for net income, and I've used some of those as we've gone along. You have the word profits. Some people use that. Earnings. Income are the most common ones people use. So if they're talking about profits, earnings, or income, there's two parts to that. There's your revenues and then your expenses. So we have to talk a little bit about that. So revenues is what you make, kind of what you get on the sale of your product. On the sale of your product. And again, it's what you get, kind of big picture, the total. So if you sell a computer and you're Best Buy, so you sell a computer for $500, $500 is the revenue. Now it costs you a little something to buy the computer. So if you bought the computer for $200 and sold it for $500, your revenue is still the $500, but your income is less than that. Your income can never be more than your revenues. If you did something backwards. Because again, you take your revenues minus your expenses to get your net income. So that's your revenues. Okay. The expenses then are what you spend to run your business. Okay. So your expenses are the things you do. So that one of the most common, again, is you might have your cost of goods sold. And that's, again, the cost of the goods you sold. So I'm going to try to squeeze this in here. So going back to our Best Buy, where we had that computer, we sold for $500, but we bought it for $200. Our revenue would be $500, but your cost of goods sold is $200. And so then your income or your profit would be $300. So it's you work your way down between your revenues and your income. Okay. So cost of goods sold is one of them, and then all other expenditures. It's kind of using the same word. Items you pay for are also under expenses. So you have your salaries, you have your utilities, you have your rent. All those things are expenses. Anything you have to spend to get your business going. And then the net of those is your net income. Again, people call profits, earnings, income. That's all what's left over. So I really do suggest you watch Shark Tank if you don't, at least once or twice, because they often will walk you through, okay, well, what's your revenues? And one group, they ask for their revenues, and then they ask for their income, and the income was bigger than the revenues. And they said, you don't know what you're doing. You don't understand what we're talking about. So that's one reason we need you to do this, okay? Let me put one more up here. Another one, sometimes people will call it, is margin. Sometimes I call it gross margin. I think I'll stop right now, and we'll finish the rest of this in the next lecture.